The data's pretty quiet, so what the market's focusing on really is Nvidia earnings. Now, this has been the runaway AI stock, and Friday night was a weak day on the Nasdaq. Interestingly, super microcomputers had a huge reversal lower, and that had doubled in the last 2 weeks. So it looks like maybe the Nasdaq, the AI move, is in its last legs.
Hi everyone, welcome to another market episode of World of Oil Derivatives. I'm the Chief Executive on Onyx Capital Group, Greg Newman. I'm joined today with James Brody again and Vincent Wu, who's back from Sing, so he's actually physically here today. We're going to go straight into it. Really interesting week for oil markets and macro alike. Do you want to just start us off, Vincent? What's been going on?
Yeah, sure. So it's been quite a bullish week for crude flat price. It's been supported above $80 levels, reaching a peak of $83.50, which seemingly it's finding resistance at current levels. But overall market sentiment has been quite bullish from hedge funds, from speculators alike. This has come on the back of continued geopolitical risk premium, growing risk of wider conflict in the Middle East, as well as by slight weakening of the US dollar recently, as well as, a lot of traders anticipating rate cuts from central banks. So overall, the market is really firing on all cylinders. You also have strength in the refinery margins, perhaps a bullish factor for crude demand as well.
Yeah, I think it's got to be said, these sound like things we kind of talk about relatively often, but actually lately it's been, the margin, when we say refinery margins, we expect, $4 or $5 per barrel roughly on average in Europe. They're up at like 10, maybe even more. There's been a huge performance in those product markets. And that has led to a genuinely an incredible strength in the Data Brent markets. I was trading myself last week for a day to check it all out, and it was just nuts. Super strong buying from pretty much everyone, physical clearing at very high levels. And of course the Brent time spreads going with it, WTI time spreads. There's just everything, as you say, it's like everything together is rallying very strongly, which has finally kind of filtered through to flat price to some extent, but it's probably relative to what's going on in the underlying. It's a very tame move, 83.50. It's pretty much still in that range that we've had this year, like not much far above it. The way the market's trading, you would think 88, 90 plus is around the corner, which kind of shows the dislocation with macro sentiment. Possibly we could talk a bit about that, but I think the other big thing, like watching markets, is that we talked a lot about Q3 buying in products, and Bloomberg did an article on it recently, like record open interest in these product differentials. Everyone just piling in to put their risk in Q3 products from the professional oil space, because that's where they think there's the most bang for the buck this year. But it ended up dragging up the whole curve, and now you've got prompt and Q2 product cracks at super high levels that actually refiners are just loving it, jumping over themselves to lock in crude, buy crude, lock in their buy side hedges of crude. But they're also, of course, selling products to lock in that differential. And that has kind of reversed things lately. One bottom left to top right move. Now it's bottom right to top left kind of move in Q2 cracks, which is like really significant. Shows you there's going to be loads of product online. And we're going to be really testing the market in the next kind of month. Can it sustain all this product that's going to come online once refineries are back? And can it sustain this like crude strength? Do we get any demand destruction with everything going on? $83 a barrel on Brent futures is one thing, but then if you add the kind of margins, we're looking at the mid 90s. And historically, at least in the last few years, that's when we start to get towards demand destruction levels, whilst the macroeconomics are not looking like hugely, attractive. So maybe James, you could jump in there, like looking at oil, but from a macro perspective, is the general pressure from the macro sentiment on the bear side, would you say, lately?
I would say it is. I mean, what we've seen out of China overnight, the central banks cut the 5-year loan prime rate by 25 basis points to 3.95%. Not only was that unexpected in the market, also this was the biggest move they've ever done. And this, I don't want to say panic, but this highlights the urgency the central bank are trying to stimulate growth in the economy.
And in general, though, like looking at, slightly weakening of the dollar, like Vincent mentioned, things in the spotlight again is, are we actually going to get the soft landing? Whenever a soft landing is mentioned, I think 2 or 3 times in the last couple of years and more before that, it actually predicates a pretty big sell-off. And you've mentioned that a few times. Like last year, we all promised this sell-off, but actually maybe it was just delayed to this year. And it's starting to be a few of those signals. At least from China perspective, that's an economy that has been torn apart, it seems, week in, way out. You see the next bearish thing. And like you just said, we've had some stimulus, yet metals are down. All the Chinese are on the sell side of things in oil, which kind of shows you that it's not really doing much, which is even worse, right?
And in the last week as well, we've had the recession being confirmed in the UK,
right, yes,
and in Japan, although that's backward looking. The only minor part of growth we've seen is last week, we're seeing the economic data in the US coming out slightly above expectations. It's still weak, but the manufacturing data in the regional Fed surveys, particularly last week we had the New York Empire and the Philadelphia Fed surveys, they're still showing weakness, but they've had a small bounce. So maybe the economy can level off here, but these are secondary indicators. It's been pretty shallow on the data front.
And I guess therefore it makes sense that when you go back to oil, you have this underlying strength, but then the macro demand is so important. When we talk about derivatives, we're talking about things that are genuinely in the future. And so people might be buying it on the basis of what they think is going to happen. The market catches a bid. You've got some forward fixing of physical, but it gets high enough. When it gets to actual pricing of those contracts, that's when it starts to be priced to actual exchanges of physical contracts, and that impacts the price ultimately. And that is when the market gets tested. And I think with everything that you just said there, James, it's like you would think from looking at the oil markets that there's an incredible amount of demand. And I think that the reality might not be there. And I think if I talk about demand destruction again, these levels that it looks like we're approaching at the end user level and could be getting quite a bit higher. Can the macroeconomic environment really sustain another bout of inflation from energy?
Absolutely. You're just not seeing the demand at these levels.
So I think higher prices then, artificially so maybe, but whatever the case may be, the price will be there. The end user can't really take that, right? We're still at 4% UK.
Demand falls.
Demand
Absolutely.
falls. But I'm saying if we get another bout of inflation up to like 6-7%, that probably is very likely to trigger a pretty serious down move. It's what the market really doesn't need right now is what I'm saying.
Absolutely.
Okay. Vincent, what about CFTC? How people are positioned? Kind of some of the headline stats.
Yeah, looking at the CFTC, so we've been seeing like hedge funds loading up on positions in both crude and refined products, but especially in crude futures in both Brent and WTI. So there's a focus on Brent, over 46 million barrels of long positions opened week on week. That's to the week to February 13. So it's an interesting one actually, because for the past 3 weeks it's been more going long and then short and then going long again. And there was a brief sell-off in Brent's 2 weeks ago. So overall, the bullish, it seems like hedge funds do want to be quite bullish, and then they've been getting increasingly more bullish in gas oil as well, in line with all of the geopolitical tensions as well as all of the strong refinery margins and stuff going on. But interesting enough, in RBOB and US gasoline, there's actually been, despite strength in the US, there's been more increasing amount of short sellers as well, trying to essentially sell from the highs or enter from these like relatively high levels.
Refinery margin hedging.
So we're talking, you do have refinery margin hedging, which
Are you talking about gas oil or are you talking about Brent? Sorry?
We're talking about US gasoline.
Okay, yeah.
US gasoline, more shorts coming in, definitely, like with on the more niche future side, EBOB cracks, more selling as well. But in terms of Brent futures, WTI futures, more bullish sentiment coming in. There was 1 week in the US where sentiment was a bit more dampened because of the Whiting refinery outage, which meant that there was more builds in Cushing, as well as a massive EIA stats build last week. But all of that seems to have dissipated as...
I think this is a key thing as well. Market pricing in an incredible amount of demand, but really a lot pricing in of refinery outages. So we had another Grangemouth issue in the UK over the weekend. Relatively small, but it does import North Sea oil, so it can have an impact on the Brent pricing there. But more importantly, Whiting, a huge refinery in the US, generally weather kind of disrupting things. We had such cold weather that production was genuinely taken offline in the US. But I think if you read around, when it does come back, it comes roaring back. So I think the 12 million build in crude stocks in the US that we saw last week on Wednesday reported pretty logical. But the refinery utilization was down again. And that was really unexpected. So we're talking 1 to 2% when we say less utilization. But that does have a huge impact, and it's undoubtedly supporting basically the bullish sentiment in product cracks. But ultimately, as I'm saying, it's pricing that now when it gets to actual pricing of the contracts and the involvement of physical is there. You can price in outages, but if you don't have the outages, then it needs to correct. So it's looking at these levels that you're just running quite a bit of risk being long right now in these cracks, because a refinery outage has to happen for it to that's how it seems. So once you've priced in, it kind of needs to happen. Otherwise it's going to tube south. And I think a long market combined with, the lack of these things will mean that it looks quite bearish on the crack side, but still bullish crude, because ultimately the refiners are consuming the crude because they're really aggressively locking in these levels on the derivative side, which means that they can run no matter what happens. Cool. So what about Googling oil? Some key headlines.
Yes. So on terms of Googling oil, we have the key headline is actually came from a Bloomberg article of the weekend. Traders, if you see on the screen, traders scale fuel markets for profits as crude prices drift sideways. Actually quotes yourself in the article as well. Quote Greg Newman. Traders are betting on product differentials performing as an expression of their view rather than outright crude prices. Summer products have performed consistently over the last few years, so are being seen as a safe bet. So overall in this article was just talking about, because of crude prices like Brent futures being so sideways in terms of price action, people are focusing more on the futures market in terms of refined products like gas oil, gasoline, so on and so forth, as well as the more niche futures such as naphtha, fuel oil, so on and so forth. So which is exactly the kind of niche markets that we cover, and that's our expertise.
Yeah, it was interesting in that article, heads of oil of exchanges, ICE and CME were talking about that kind of concurring, right? Ultimately that unexpected or at least localized buying in these niche contracts. And we always say it, this is the real oil market. This is what needs to be opened up for, retail investors in the long term. But that's cool. So what else other than that?
Other than that, we also had a recent FT article, quite a big one, talking about the Permian Basin deal wave heralding a new phase in shale oil revolution. So it's a combination of what we've been talking about over the last few months about a lot of mergers and acquisitions happening in the US oil industry recently, a lot of consolidation, especially relating to US shale oil. So right now, 10 companies control over half of the overall output in US shale, and 6 of them produce over 700k barrels of oil equivalent per day, which is more than some of the OPEC countries. So the recent deals, as a refresher, includes Exxon and Pioneer, Occidental and Crown Rock, Diamondback and Endeavor, and the pending acquisition of Hess by Chevron. So overall, it seems like the shale revolution has transitioned from an expansionary into a managed consolidating phase, as companies focus more on shareholder returns rather than focusing on increasing volume and output. So especially with a lot of private operators being absorbed, it's becoming, we're seeing more of a shift from small independent companies in US shale into more consolidated big oil companies. And with all of this consolidation, it's expected that the break-even cost of production can be reduced by up to $5 per barrel down to from 35 to 30. So more efficiency and more returns to shareholders' pockets. That seems to be what the direction that the market is going to.
I think in the article it mentions something about higher prices with this, because they're not going to be ramping up all the time. I think that's a mistake. I think, it's contradictory to say that and then say that the break-even costs of drilling will go down, because If that goes down, then what you're looking at is less swing production, right? Really robust supply. That's what this consolidation does. It guarantees this added production stays there. So when we went down in times of low times of 2020 and prices destroying production, having to down tools and then work back up again, that's a lot less likely to happen now because you've got more stable supply and these guys are acting more like producer countries. So I think that's actually very bearish. I think, yes, they won't be hedging. It doesn't seem like that's a mandate for these bigger companies to hedge big sizes, and therefore you don't have that selling pressure on derivatives. But I think for people relying on supply and demand modeling, it actually will be a thorn in the side of OPEC. I don't think it gives the power back to OPEC at all. I think they're going to have to factor in this robustness that's bigger than the biggest producer in the world now as a country. So I think to me that's long-term bearish. But cool. So that moving on then, going back to I guess to the kind of niche stuff. What's your trade idea for this week?
Right, yes. So the trade idea this week is to go long in the naphtha crack. So as you see on the screen, recently the past week has seen very bearish price action, but on Monday saw a source of support at the minus 950 level. So it is a very contrarian one. Seems as if the price action has found the bottom on Monday after an immense sell-off over the past week. So the theory is, our justification is that, so yesterday we finally saw better buying at the lows, especially in Q2 from funds and trade houses, whereas physical buying flows came in at the front. Technical indicators see that the naphtha has been quite oversold. We think that despite this fundamental correction downwards in terms of price action, the correction has been overdone. And there's good risk reward to go long, especially with from our COTS dashboard, we're seeing from the naphtha crack, the overall long market remains in the money at these levels. So the legacy length, we've seen trader entry level at 12 months minus $9.46 per barrel, and precisely that's a level where it found support yesterday. So in that sense, we are expecting existing length to defend their positions. And also with a lot of recurring attacks on Russian oil infrastructure, this could provide a more bullish upside to.
Yeah, that's a really cool point, actually. People worrying about these drone attacks on refineries, Russian storage facilities. We talked about it not really having a massive impact on the outright oil market, but having more of an impact on the niche futures. And I think this is a perfect example. Like naphtha is genuinely responding to these attacks, and I think something on the oversold territory could genuinely leave that very vulnerable. So that's a really cool one. And I think again to refinery outages as well, if those do actually happen, that plays into that hypothesis as well. So interesting. With your stop loss a little bit tight, but you're making the argument that it's on its downward trajectory, so you're kind of wanting to exit quickly if things look like the trending down wasn't over, basically. But I think as you've seen like a bit of an uptick, you've got quite a clear scaling level quite aggressively. If you're looking for, say it went down to, I don't know, 950 here, you're buying $9 roughly, and you're expecting a resurgence back up to the kind of 758 level, then you've got a bit of time, you've got a bit of room to buy again, right, as the trend is being confirmed. With a trade like this. So that's what I'd add there. Cool. Right. Last week's poll, we said, where do you see the front month European refinery margin this time next week? We gave levels, but obviously everyone has a different calculation. So I think essentially it was down, staying the same, or up. And I think most people, 48% said it will basically stay in the same range, but it did collapse as all the refinery margin hedging rushed in. So that's quite an interesting one. Be interesting to do a kind of new poll again to kind of see where people's thinking, what people are thinking is now that we've had such a structural change in the products. James, before we sign off, things to look for in the macro market in the next week.
This week, Greg, the data's pretty quiet. So what the market's focusing on really Wednesday night is NVIDIA earnings. Now, this has been the runaway AI stock. And what we saw on Friday, yesterday was a US holiday. Friday night was a weekday on the NASDAQ. And interestingly, super microcomputers had a huge reversal lower, and that had doubled in the last 2 weeks. So it looks like maybe the Nasdaq, the AI move is in its last legs. I read over the weekend as well that teenagers are opening trading accounts, equity trading accounts in record volumes.
Wow.
And when teenagers are marginal buy, you think that the trends may be coming towards the end. So that's really the highlight of the week.
To Gen Z. No, I'm hear you. That's really, really interesting. And I guess that tends to play into the hands of meme stocky type buying, right? You're buying things that are hot.
You're chasing it higher.
Yeah.
To the moon, as they said in the crypto world.
Right. Okay. Very interesting. And Vincent wants to watch this week.
Yeah, wants to watch a few ones. So seeing, like, as you mentioned before, how refinery margins will continue to trend over the next week. We've seen a sell off in EBOB and gasoline and gas oil cracks. When is that going to catch the bottom? As well as looking for post Chinese New Year flows, because liquidity was pretty quiet last week. So a lot of traders are coming back, and also got our traders' favorite IP week in the coming week. Of course, we got an event going on as well.
Yes. But
during this time, a lot of industry executives, traders are all coming to London, and there'll be a lot of discussions about what's going on in the market. One of the niche futures as well, is that going to be the Red Sea? Is that crude going to reach $90, $100? So there's a lot of narratives. Maybe people are going to push particular agendas.
It's always interesting IP week. There's always something that happens. There's always a surprise. I would add to the ones to watch that the Red Sea has been a bit quiet of late. At least people kind of the media seems to be a bit bored about reporting about it. I've seen some key freight routes being quite bid, meaning like there's genuinely imports going on, particularly, say, for example, Saudi propane. Actually, the team was bullish. FEICP put that out. That was, a really good recommendation across the curve. Didn't actually perform in the contract so much that they suggested, funnily enough, like an okay performance. But anyway, the point is that it kind of rallies with more imports and freight from Saudi to Far East Asia going up, and it certainly has. So it's an indication that things are moving, and I think that if the Red Sea has any sign of easing and people are starting to use that area a lot more from a shipping basis, then it could lead to some pretty big moves on these product differentials we're talking about, namely kind of east-west contracts that have been forced out of whack. In gas oil, for example, NATFA would respond very aggressively, and it could change the whole supply and demand economic quite substantially in a moment where a lot of people are long in products, and in a moment where there's quite a bit of volatility in this underlying market. So I think it's something to look out for, because if any ceasefire, Israel, Palestine seems to have a bearish impact on flat price, a risk-off move, and the Red Sea easing. It might look like a relatively mundane thing on flat price, but it will have big impacts on the products, which, as I say, when people are so invested in it, things like this have a much more of an impact. So it's definitely one to watch there, again, in my opinion. We'll leave it there. Thank you very much, listeners. Again, thank you very much for listening and for subscribing, and please continue to do so. It really helps the channel. And we'll see you soon for more of the same next week.